welcome back, everybody. Wanted to bring up a discussion that during great market times, this is how difficult investing is. During great market times, our psychology wants to say to the world or to ourselves, okay, well, it's just a matter of time before this thing drops again. And then, of course, when it drops, and because economics goes in cycles, right, our psychology is, oh my gosh, it's going to keep on dropping even more. And then when it starts to rise again, it's like, oh well, it's still going to drop again. And then eventually, when it gets high, it's like, well, I've now missed out. So it's this complete emotional roller coaster. So it's our job to help fill in some of those underlying knowledge gaps. So a chart that I found here I thought was pretty interesting. Is this table of all-time highs, and it's just important for us to know economic history. And let me know if you guys can see this properly. Colin, can you guys see this? Okay.
Yep.
Okay. So if part of your psychology around today's markets, because markets are doing really great, is, oh my gosh, well, the markets, again, it's at or towards all-time highs, depending on which benchmark you're looking at. Well, this is not the first time that's happened. In fact, when you look throughout history, we've had obviously a bunch of all-time highs laced throughout history. And what the data is showing is the average S&P 500 index 1 year after the all-time high tended to skew towards about 14.55%. The 1 year gain thereafter, which I thought was pretty interesting data. Now, again, the whole disclaimer, right? Like past results not equal future predictability, et cetera, et cetera, et cetera. But to know history is really important when it comes down to becoming a good investor. Colin, let me throw you over the mic, buddy. What's your take on this?
Yeah, this is fantastic, right? Because it kind of dispels a narrative that many investors take as fact, right? That, oh, hey, it's we can't go any higher. We've been on this heater for 5 years now. Eventually the shoe is going to drop. Yeah, sure. I mean, that prediction will ultimately come true, but at what cost to your portfolio? Right? This is, we've pounded the table for years at this point on this, but this is the importance of sub portfolios. If you have correct time horizons around your equity portfolios, around your long-term investment portfolios, and you don't have a gun to your head to sell and to liquidate any of those holdings in the next 12 months, well, you shouldn't be nearly as worried about being at all-time highs. And I don't know how this is going to play from a compliance perspective, because yes, we are obligated to tell you that past performance does not predict future performance. I don't know what would be a better indicator of future performance than past performance, though, right? Like you just look at it in regards to your relationship. I mean, you wake up every single day, or I wake up every single day, with a history between my wife and I, knowing that like I could kind of expect how she's going to act in the morning, right? Because of past performance. Right. So I actually personally disagree with that notion. I think the best indicator of future performance would be past performance. It's just not an absolute. Right? We can't guarantee that because the S&P has returned 10% for the last couple hundred years, that it will continue to return 10% for the next couple hundred years. But I don't know what better, what better data point than to look back historically and say, hey, after all-time highs, how does the S&P 500 perform? Well, wildly skews towards the positive, right? So you can't be scared to invest or deploy capital at all-time highs just because there's a narrative in your psychology about, well, the bottom eventually has to drop. The amount of times I've heard that in my 8-year career, I can't keep up with. All the market has done in, not just the past 8 years, but for the course of everyone's life on this call, has continued to climb to newer and greater highs, right? So, but it is interesting to see the math, and I think again, as you pointed out, Wes, it is our responsibility to bring facts to the conversation and see, hey, is our psychology and is the narrative that we're hearing or telling ourselves actually represent it in the underlying data. And this is one of those times where typically that doesn't align, right? In to the better, right, or to the investor's betterment.
Well, and I also think what matters is in business we call these vanity metrics. It's a similar situation. A lot of what pushed the are not this type of metric or high metric is all versus that's getting away from what is causing the increase in valuations of the underlying companies. Well, they're selling more goods and services over the long term. So I saw this pretty interesting chart. Let me show you guys because I think it's so important to be connected with what the investments actually are. And again, it's really easy to understand the concept, but it's harder to grasp the actual magnitude. To what degree are these things valuable? So if you look at this from the Visual Capitalist, great charting company, the top 10 US companies by net income. We're not even talking about revenue, net income. I mean, look at this. Alphabet, right? The parent company of Google, $100 billion in net income. Apple, $94 billion, right? Berkshire Hathaway, $89 billion. Microsoft, $88 billion. Nvidia, $73 billion. Meta, $62 billion. Amazon, $59 billion, et cetera, et cetera. I can go on and on down the list, right? This is insane. I mean, just imagine you went back 3 generations ago and said, hey, by the way, there's going to be companies making net income of around $100 billion. That is absolutely wild. So now we're not even talking about revenue. So I looked up Google's revenue from 2002 to 2024. If we look at 2024, their revenue, $348 billion. I mean, these numbers, it's so hard to comprehend because the human brain, it's difficult to understand how vast those numbers actually are. If we break those down, let's say the net income revenue down to an hourly basis, right? That is $11.4 billion. I'm sorry, $11.4 million per hour. That's crazy. So it's just know that, and we're not endorsing any companies here. We just want to give the concept of how large these businesses have gotten, how productive they've gotten. Now, just to add to it, if we take Google's revenue, top line revenue, and we break that down per hour, I just asked ChatGPT real quick. That's about $40 million per hour. I mean, just imagine, Jimmy, right, that your company produced $40 million per hour. It's hard to even fathom. So that's where these returns over the long run are coming. It comes down to business productivity, increasing the quality and speed and efficiency of goods and services being produced for other humans. Colin, what's your take?
I think that it's very rational, right? Like what should happen to the valuation of Google if revenue and net income continue to climb in a very consistent, predictable, and increasing capacity, right? Well, naturally, you're going to have people that will pay more for ownership of the company, right? As they should. This is really before all of the AI hype being actually
Yeah.
realized in the company, right? I mean, this is revenue and net income off of current set of office suite services. Right? This is not a bake-in of, hey, what their robo taxis or humanoid robot or artificial chat boxes or whatever, whatever technology innovations are coming down the future from that company. Yeah, on top of the increase of revenue and net income, there's also a narrative of how world-changing they might be with with this next wave of technology innovation that we seem to be already well underway in accomplishing some of the dreams and some of the aspirations that these companies has talked about for the past handful of years. So yeah, it's very rational to me, right? When you look at fundamentals of a company, there's probably an argument, and yeah, I wouldn't put my neck on the chopping block for this, but there's probably an argument that there's no stronger balance sheet on planet Earth than what Google has, right? From a structural standpoint, from a balance sheet perspective, it's about as good as it gets, right? And that's why valuations continue to climb. Very rational, but I think you pointed out something that's incredibly important to the conversation. It's just at a size and a magnitude, Wes, that's so large that it's like hard to comprehend. It wouldn't be as hard to comprehend if you looked at your personal business or the pizza shop down the street from you and saw that their balance sheet, the amount of pizzas that they sold, just continuing to J curve to the top right hand quadrant, right? You would say like, oh yeah, that company's going to be worth more. That pizza shop is going to be worth more, or put up additional locations, or sell for a higher valuation than they would have last year, given the success of the business. Right? Google's just so stinking large that yeah, even the United States government was considering breaking them up, right? Because of the size of the company that we're discussing here.
I mean, it's so large that it has a whole bunch of other products and services inside of it that there's a strong argument those should be their own standalone companies.
100%.
Waymo would be an example. It's pretty fascinating on how large these companies have gotten, and how much innovation is
Yeah, I
baked
mean,
inside of it.
I'd wonder just how much YouTube would sell for, right? Like,
100%. Yeah.
yeah, or
Or
again, we
Chrome, the
can,
browser, et
yeah,
cetera. Yeah.
we could channel out so many like divisions of their company that would be incredibly successful businesses if they just stood alone.
Yeah. David, I think you said you had a question, right, bud? Dave Braun.
Yeah, had a question on your original chart, Wes, if you could bring that back up. I
Yeah.
was curious about that. It's very illuminating. Thanks for that. And yeah, I agree with you guys. Looking at the history is a great way to predict future performance on like anything, right? Companies, um, people, all that stuff. So like let's take the very first one. On September 22nd, 1954, S&P 500 was an all-time high, right?
Yep.
The
Right here.
return 1 year later was really high. I'm just wondering why wouldn't there be another S&P 500 peak in 1955, for example? So I don't.
Why there would not be another peak?
Yeah. So in other words, the
Yeah.
all-time high, what this chart is saying that a year later, the returns are at a 41% greater than at that high.
Right.
So I'm
Yeah.
not sure why 1955 wouldn't have another all-time high.
Yeah, I don't know that this chart was produced from, where was it? I think like either Hartford Funds or yeah, Hartford Funds. I don't know that they're making the claim that they've recorded every single all-time high. I don't know. Or I don't know if they just peaked it at like certain years. I don't know the level of data there. I also didn't want to like mess with it, if that makes sense. Just took a screenshot. So
Yeah.
I could get back to you on that answer.
Yeah, I'm just curious. I mean, the chart kind of makes sense in certain ways, but when I was thinking about, there's a big gap there, didn't make sense in my brain. So I thought I'd ask you guys. I asked the experts.
Yeah, no, absolutely. I mean, the moral of the story, right, is like, and it's very logical. This is like when people make the arguments of oh my gosh, right, like innovation is going to make it such that people are out of jobs, right? It's like, well, we've had innovation for generations and our unemployment is basically at all-time lows, right? So it just logical, right, that it's self-solving. Same thing for market highs, right? It's like clearly, so if we're at a market high, let's just say, um, well, we've had market highs in the past and now it's higher. It's all been self-solved. But it's where people start to parrot what the media is saying, not realizing that the sole job of the media is to get more eyeballs staying on their content as long as possible. So they have to say sensational things. And that also happens to pair with the emotionality of investing. Oh my gosh, well, the market's at all-time highs, therefore it must stand to reason that it's going to drop. Why? Did you do analysis on that? What's the price to earnings ratio? How much revenue is being generated from the underlying companies, right? Like, show me the balance sheet research that you've done to conclude that. And I'm only pushing on investors in this way for their own benefit. period, I think it was like 20 or 30 years, the data shows that if you miss the top 10 trading days over 3 decades for that particular data set, you would have destroyed your returns by more than 50%. 10 trading days over 30 years. The best trading days over 30 years. That's crazy. I think it's like if you missed the top 30 days, right, you would have decreased your investment returns by 84%. Now I'm just going, I probably got some of those numbers wrong, but they're roughly accurate. That's insane. And these false narratives are the origins of making those wrong decisions. And then I have this other data. I'm trying to find it real quick for you guys. I thought it was really profound as well. There is something to be said for the duration of bull markets relative to bear markets. Bear markets feel super long because they feel intense. The media perpetuates this, et cetera, et cetera. But the reality is, if we look at history, let me show you this. Let's just take note of the duration of bull markets relative to the duration of bear markets. So hopefully you guys can see this chart. So this is bull markets tend to outlast and outweigh bear markets, S&P 500 index rolling returns from 1928 to 2023. The important thing here is just look at the blue spaces here, the surface area of the blue spaces relative to the gray. So you now have a proportional understanding of, yes, bear markets happen, of course, and we always want to try our best to build portfolios that take that into consideration. But please don't talk yourself into, oh my gosh, well, it's so good, it must be bad right around the corner. Just look at the durations here. Colin, what's your take on this?
Well, look where we're at today. For all the
Yeah.
hype of we're overvalued and relative to the last bear market, it's not nearly as peaked as some other times historically, right? Um, I think you mentioned something, Wes, in passing a few minutes ago that is incredibly powerful, right? And I often see this with real estate, like, oh, grandma's home investment was was an all-time winner for her.
Yeah, yeah.
And the way that people talk about real estate returns as it's absolutely no doubt about it a good decision to buy a home versus renting home. I'm not planting my flag in either category, but what I do want to point out is the authority in which people speak, stating that when they've never once put pen to paper and have done the math on is it a good financial decision or not, right? So the same authority translates when we're talking about markets. They're so certain that the next time it will be worse than any time before without ever looking at a company's balance sheet, without ever looking at the price to earnings ratio of the S&P 500, to not even considering what the underlying earnings are of the 500 companies relative to where they've been in the past or where they've been historically, et cetera, right? So you have to really be careful at the water cooler at work or at the dinner table with your brother-in-law or whoever it is that is making these declarative statements as if they're assumed fact for the rest of the conversation when actually we're basing this conversation on something that actually doesn't play out in reality, right? So I think it's an incredible visualization of the duration of bull markets to bear markets, but we know just as human beings, pain feels worse than pleasure feels good. Wes, what's the story on the magical moments at Disney?
Yeah.
How does Disney compensate for something bad that happened at their theme park? What do they do in return?
Yeah, it's a ratio. They call it magic moments. I believe it's either like 27 to 1 or like 37 to 1, something like extreme. So if you have one bad event at Disney and the Disney staff learns about it, they try to make up for it. Let's call it 27 times just to get a little bit north of the one bad moment you've had. That's how asymmetrical human psychology is, right? To where one of the largest companies on the planet says, hey, like in order to make something good, we can't just give one thing back. We need to give it 27 times over.
Yeah, and Dad, I wish Dave was here to also chime in, right? Because over 55 years, some of the most important lessons Dave taught me was how many times he heard similar rhetoric that we're all hearing today, right? But Dad, you look back on the past 40 years, right? How often has the conversation, pivoted from, well, yeah, we might be in a bull run right now, but the bottom has to drop, right? Like seeing the actual visualization of bull markets relative to bear markets, even with all of the data and all of the facts and all of the history clearly articulated for us, how many times have people walked in the office and said, hey, this, that, or the next about whatever the headline of the day.
Yeah, completely agree. And then as you guys were talking about this, I stumbled on this literature a little while ago. I want to show you. So there have been studies around this. So this is again out of I believe out of Hartford Funds. And it's called Reality Timing the Market is Impossible. And they did this study and they looked from 1926 to 1993. If timing the market were possible, every investor would be easily and outrageously rich. Scholars have estimated that from 1926 to 1933, any investor had and you can see the number of zeros here, right? 0, multiplied by, seems like 100, 2,883,555% chance of timing the market correctly all of the time, right? I mean, basically impossible. 0% chance. Now, can you catch lightning in a bottle once and get lucky? Yeah, maybe. And then the neighbor who does it and gets lucky, then they go about town saying like how they had some secret formula when we know that's not the case. Let the underlying companies do their jobs, sell more goods and services, produce value for society, and think about how awesome it is that we get to buy into that, right? We get to own pieces of companies where these geniuses and just productivity machines to the tune of thousands of employees are able to do that just by you and I buying shares. Pretty wild. Colin, let's switch topics here. Give us an update on the recent inflation data, if you don't mind.
Well, it's a great segue, right? Because we have always encouraged people not to trade off of headlines, right? And we're not really bringing up inflation data to get super in the weeds about some of the underlying nerd assumptions and calculations. But I think today's producer inflation print was an important one because it was actually deflationary, right? What has been all of the rhetoric and all of the talk all year long around in inflation, right? That tariffs were guaranteed to increase prices, and businesses and consumers would take the brunt of the hit. Well, month over month inflation for the producer performance index actually fell, right? Is negative. So deflationary is cheaper to produce goods this month than it was to produce the same products last month, right? And I think core inflation, same thing. It dropped a little bit. And then year over year, they were estimating it to be at 3.3%. It came in well below expectations at 2.6%, right? This is not a projection of what's going to happen to inflation in the future or what's going to happen to consumer prices or anything of that nature, right? But I do think it's, again, important to point out that if you would have traded off the headlines of tariffs are going to be inflationary, well, we are now what, 8 full months into this, going into month 9 now, and that's not true, right? And it could have cost you, and unfortunately, I know some people where it has cost them, right, against our recommendation and against our advice, hundreds of thousands of dollars. You really do not want to get in the game of trying to trade your retirement off of headline news, right? Even if every single publication, every single news company out there is printing the same exact thing, right? If that were true, economists globally thought that tariffs would be inflationary. They're wrong, right? At least if we snap the line right now, right? And this is, unfortunately, I'm not trying to get political. Unfortunately, this bleeds into the politics, right? So you got to get rid of that if you want to have an intelligent conversation. You got to leave the politics behind. Inflation has not shown itself the way that it was expected to because of tariffs. Again, this is not a projection of what might happen into the future, but to this point, you could have cautioned. It did close at all-time highs yesterday, right? You could have cost your family a lot of money by not staying invested in the companies in the quality portfolio that we want to invest ourselves in. Or you could have cost your family thousands or hundreds of thousands of dollars or millions if your accounts are big enough, right? Millions of dollars because of a headline that never came to fruition that was largely engineered because of a political bias. Right. So
Yep.
it's just another warning sign to be careful about trying to align your behavior with the headline of the day.
I agree. I think a lot of these things, we always have to ask yourself is, is this going to be news in 5 years? Going down 25 basis points to Colin's point, I don't think it's going to be earth shattering. Now, does it matter for large businesses who are borrowing capital, large sums of capital? Of course it does. Absolutely. My personal opinion on this is, I, I'm keeping this very high level, but when times are good, I prefer to not cut rates personally because it's one less tool the Federal Reserve has to deploy if we actually get into a really big jam like we did, let's say in 2008, COVID, et cetera, et cetera. So that's just my personal opinion. But then you can get into the really nitty gritty. Well, what should be baseline level of rates? If we look throughout history, I mean, that discussion could last for 10 hours. But we'll see. We'll see what happens next week. I mean, as of now, I think the way the markets are turning out for this year, we didn't have to go back too many months ago where a lot of people were claiming, right, that the world was burning up, and the sky was falling, et cetera. So, not that all of us know this stuff, but as they say, oftentimes you need to be reminded instead of taught. And to that end, I think our buddy Warren Buffett, again, this is not an endorsement of a company, just purchased shares of United Healthcare, right? So yet again, showing his optimism for American-based business. We all know the tragedy that happened with United Healthcare not too long ago, and Warren, in true Warren fashion, is buying up shares of a company that are particularly, in his view, depressed in price, especially because of some, right, like, I hate calling this an optic, but some sort of optics with the company. So, Colin, what's your take on that transaction, bud?
Yeah, he's obviously not scared of the markets being at all-time highs. I know the company that he purchased was, at a steep discount, nowhere near its all-time highs, right?
Yeah.
But it's a vote of confidence in American business and a good reminder of that's what we're actually invested in. Even if you choose to invest in group-based assets like we typically recommend, right? The core underlying assets in all of your portfolios are companies. They are businesses. They are not the stock market, right? Unfortunately, I'm a Cleveland Browns fan, right? And I was just using this analogy the other day with somebody of like, it would be like blaming the stadium for the Browns outcome on Sunday, right? It's like the Browns players and coaches lost the game. It had nothing to do with Huntington Bank Field, right? The stock market is just the arena, right? And typically we are pointing at the stock market as the reason, I lost money in 2008 or something like that. And it's like, no. That's just the organization of all of the assets so that they can be traded at a marketplace, right? Do not blame the arena for the performance of the underlying asset, right? So yeah, I think we got to be very careful when we have these very broad stroke comments or determinations about, hey, the market's overvalued or whatever. Certainly not every company on planet Earth is overvalued right now, right? That is a deterministic outcome that is just frankly false, right? And the greatest, in my opinion at least, the greatest investor of all time has just put a $100 billion vote of confidence behind an American business that had some pretty nasty headlines attached to it, right? So, kind of in theme of something that I may be shouting over and over again today, you have to be careful about what the headline says because Warren's already made a ton of money off of that investment. If he were to choose to even sell this quick, right? Just a handful of days in.
Yeah. All right, guys, let's we'll have a little bit of a shorter one. Let's do a final words of wisdom here. If anybody has any questions, of course, please raise your hand. Let us we'll call on you here. Colin, any final words of wisdom, buddy?
Fundamentals executed over time. It's going to separate you from almost anyone you know. Finance is no different than any other walk of life. fundamentals executed at the highest level and for as long as possible. That's what made Warren Buffett Warren Buffett. You can be your family's Warren Buffett. And I truly and genuinely mean that.
Yeah, and my final words here, thank you guys for always showing up and people who listen to the replays, because
Amen.
each of you are financial leaders for yourselves and for your families. And I say that sincerely, right? It takes effort, it takes time, it takes discipline, it takes emotional stability. It's really hard to do this stuff. So the fact that you guys are educating yourselves means a lot to us, and I know means a lot for your families. You guys probably don't hear that enough. So it's coming from us. Anyway, love you guys. Have a great day. Reach out to us if you need us. See ya.